We are now on the reading overview of equity securities, and we're going to combine LOS-A and LOS-B in one go. Keywords on both of these are describe. A is describe characteristics of types of equity securities, and B is describe differences in voting rights and other ownership characteristics among different equity classes. Kind of hard to separate the two. It's just a lot of extra work, so we'll just combine them. So before we start, let's sort of put things in perspective. When we talk about equities, we'll look at a few global facts here. And there are three that are pointed out in the reading. I thought would pass them along as well. If you look at the ratio of the equity market cap to global GDP, over the long run, it's run about 50%. So as that starts to get higher and higher, 50, 60, 70, 80, 90, it starts to indicate that maybe global equities are somewhat overvalued, and that's the long-run average. From 1900 to 2011, adjusted for inflation, so the return, the little sub-R is the real return. Government bonds and bills, the real return is roughly about 2%, but equity markets have been about 4%. Now, let's not worry about the 2% and the 4%. Going forward, you can't, there's no guarantee that you're going to get 2% out of government bonds and bills. I'd say for the next 20 years, you're not going to get that unless you're going long, like 30-year bonds. But and even then, you got to beat inflation, so yield is gone. Let's not pay attention to the absolute amounts, but look at the relative difference. 4% on equity markets versus 2% on government bonds. And the reason is that equities are considered to be more risky. And since they are riskier, since holders are expected to take on more risk, you wouldn't do that unless you got more return. So the important thing here is not the 4% and the 2%, but the relative difference between the two, that equities tend over time to produce much more return than bonds, but that's what you got to get paid to take on that level of risk. And number 3, equity ownership runs anywhere from about 20 to 50% of the population in developed countries. You get closer to 50% of the population, by the way, when you have government-sponsored or payroll-deducted pension plans. For instance, in Canada, there is a deduction from all employees for CPP, Canada Pension Plan. So even somebody who has no equities and no portfolio still has some exposure to equities through CPP. But if you notice the 20 to 50% of the population, that's it. Now, if you do it as draw out a pyramid, because that's what capitalism is all about. Capitalism doesn't work unless there's a lot of people at the bottom. A lot of people at the bottom. Not everyone can be at the top. You need a triangle. Looks like a pyramid? Well, maybe it is, right? Typically, you got the top 30% and the bottom 70%, and typically the market that you're going into, the market for finance, for financial assets, this is your market right here, is this top 30%, which represents, paradoxically, something about 70% of the wealth, and the bottom 30 only represent 30% of the wealth. So your target market is 30% of the population, and equity ownership kind of shows that anywhere from 20 to 50%. And again, that's, you get closer to the 50, the more you have government-sponsored pension plans in the mix. But you should get used to that upside-down triangle, is that the bottom 70% of income earners typically have zero exposure to equities. This whole industry is set up for these guys at the top. So now that we got that out of the way, now we sort of position that, let's look at equity itself. And when we look at equity, we're talking about corporations and companies because governments can't issue equity. Well, there's no equity interest. It's only debt, right? So we are talking about ownership interest in a company. And companies have a choice between issuing debt and issuing equity. Debt is a liability, whereas equity is just a residual claim on assets, net assets. If I'm a holder of debt, I'm in it for the interest. That's really it. And maybe some capital gain, depending on how I buy the bond. If I'm buying discount bonds, I'm taking on risk. I'm looking for the capital gain. And if I'm buying big enough discount bonds, the argument would be, why not just buy safer equity? There are some instances where the equity of a company might be safer than the debt of a riskier company. If I buy equity, I'm really looking for capital gains and the dividend. So a few facts about common shares, and really this should be a lot of review for many, because if you're doing a CFA, as I've mentioned before, you most likely have a business undergrad. How you get through a business undergrad without seeing this information, you got me. Anyways, common shares, ownership interest in the company. And it's a residual claim. It's after everyone else has been paid. Whatever's left over, that's yours. So you have an ownership interest. So it is not a false statement to own one share of Google. Guys, own one share of Google. And in the clubs, the ladies say, so what do you do for a living? You can say, without lying to them, I'm part owner of Google. I'm part owner of Google. Wow, really? Hey, you're not lying. You are. If you got one share of it, you're a part owner of Google. You get to share in the operating performance. The better the company does, well, it'll be reflected in share price, a capital appreciation on the share price, and possibly increased dividends. And you participate in the governance process. That doesn't mean the management process now. Let's be careful. There's a separation between ownership and management when it comes to publicly traded companies. You're participating in the governance process. You have voting rights for the board of directors. The board of directors appoints the CEO. The CEO serves at the pleasure of the board. So you do have some say in the governance process. And in some other things. Major corporate decisions, such as a merger or acquisition, you get to vote on. That'll be put out to shareholders. The election of the board of directors, as I've said, and that can be done two ways. It can be done with statutory voting or cumulative voting. This is the more popular one. Statutory voting means every share you got one vote. So if there are 4 directors up for re-election or election, you can cast 100 votes. If you have 100 shares, you can cast 100 votes for one director, or 100 votes for each director, or however you want. No matter how you do it, all your votes must add up to 100. That is statutory voting. Cumulative voting, on the other hand, works differently, and this gives minority shareholders sort of a bigger say. Your total votes are the number of shares you have multiplied by the number of directors being elected. So you can cast, if you have 100 shares, you can cast 100 votes for each and every director. So you have 100 shares times 4 directors, you have 400 votes to cast. Now you can concentrate them, and you could say 400 for one of them, if you're a minority shareholder trying to get somebody on the board, or a group of minority shareholders trying to get one on the board. You can concentrate them like this, or 100 for each of them if you don't care. But the important thing is here, now you have a total votes of 400. So you take the number of shares and you multiply by the number of directors up for re-election or election. Statutory is just 1 vote per share. Here it's 1 vote per share per director. Sticking with common shares for a little bit longer, different classes of shares. Companies can issue different classes of common shares, and each class can have a different ownership and voting rights, and even a different claim on net assets in case of a liquidation. So as a good example, let's take a company that has a Class A and a Class B common share structure. Class A is the shares that traded on the exchange. It's held by the investing public. Class B is held by insiders. Typically, you end up with a dual class structure on common shares when the founding members of a company were a family. So that the insiders really are the founding family. So Class A is the investing public. Class B are insiders, typically of the founding family. The brothers, sisters, aunts, uncles, cousins, whatever, they'd hold the Class B shares. And it might be structured such that all the Class A voting shares can only total 60% of the voting rights. The Class B end up being 40% of the voting rights. Even if the share count is like this, even if you have 25 million shares over here and you only have 2 million shares over here, it would still be that those 2 million represent 40% of the voting rights. This 25 only represents 60% of the voting rights. So it might be structured like that. And as far as different claims on net assets and liquidation, it could be that if there is a liquidation and there is something left for the common shareholders, that perhaps Class B might get some money before Class A, or Class B might get 125% of the value that Class A gets. So Class A gets paid out $1, Class B gets paid out $1.25. It can be whatever you want it, but the important thing here is that it may represent different ownership, different voting rights, and even different claims on net assets with these dual structures. And as another twist, there are times where a company can have a dual class structure where the insiders are the only voting shares, where the investing public have no votes whatsoever, so that you have 0% voting rights over here and you would have 100 Common shares can be callable and puttable, and I bet you didn't know that, and I'll tell you, I'll be honest with you, I've never come across this ever. I've never come across a callable common share or a puttable common share. So this is more or less just theoretical and in a book for me because I've never actually seen these. I'm sure they exist, otherwise why would they be written down like this, right? But they exist. I've never seen them. A callable share, the issuer has the right to buy back shares at a predetermined call price. Well, think about that. If I know that the shares can be called back for a predetermined call price, and the price of the shares are going up, once it hits a predetermined call price, there's no motivation for the share price to go beyond that, because nobody would buy it for more than what the call price is because they run the risk of it being called at a lower price. So it would just end up flatlining at that predetermined price. A puttable share, on the other hand, the investor has the right to sell the shares back to the company at a predetermined put price. Now, I imagine that if you're having trouble floating an equity issue and you don't want to do a debt issue, you really want to do an equity issue, and you feel pretty good, but the market just doesn't trust you, you might put a puttable clause in your common shares just to get it out into the marketplace and then hope for the best, right? And if the company fails, well, good luck with the investors putting it back anyways. There'll still be no money for it. So maybe you can go ahead and put a put on your shares for the investor. If it works out, they'll never use it. If it doesn't work out, you'll never be able to pay for it anyway, so who cares, right? Let's move on to preference shares, or what are called preferred shares, or just for short, preferreds. These do not participate in the operating performance of the company. They'll sell at a stipulated par price, and they'll have a specific yield, and that's what they get. As the value of the company gets bigger and bigger and bigger, the value of the preferred shares pretty much hugs that par value of either $25 or $50, whatever its par value was. They have no voting rights unless there is a condition under which they have voting rights, unless there is a decision that directly affects the preferred shareholders, then they would have a vote. That would be pretty standard, but typically no voting rights. They receive dividends before common stock. So out of net income, all dividends are paid out of net income. But the first dividends that go out go to the preferred shareholders first, then whatever's left over goes to the common shareholders. The dividend is typically stated as a yield on par. So you'll buy preferred shares and they'll be quoted as a 4% preferreds or 5% preferreds, and that's 5% on par, whatever their par value is, typically $25. Now the yield can be fixed, which means it'll be a 4% or a 5% preferred, or it may be variable. And think about bonds. You can have a fixed coupon or you can have a floating rate coupon. This variable is referred to as a rate reset preferred. A rate reset preferred will have a lot more price sensitivity than the fixed. The fixed will pretty much hug its par value as it fluctuates. It may go higher or lower depending on where interest rates are. But the rate reset will show much more price variability. Now here you're opening yourself up to interest rate risk, whereas with the preferreds, not so much. So you got to be careful with these rate resets. They're not all the same in the book. Really just talks about the fixed. The dividend is stated as a fixed yield on par. Typically they are. But in the since the recession, since 2008, 2009, companies that have issued preferred shares have typically gone more with rate reset preferreds. You got to watch those rate reset preferreds because they can fluctuate in price. There's a bunch of rate reset preferreds floating around in the Canadian market right now for $12, $13. They were issued at par at 25. They're down to $12, $13 because their yield is pretty much disappeared. Bank of Canada's lowered rates twice. So the yield on these preferreds are gone, so you got to buy them at these huge steep discounts just to make up the market return on that. So if you're a holder on a rate reset, you do have downside price risk. Be careful of that. Even though they get dividends before common, and even though it can be fixed and stated, it is still ultimately discretionary. The board of directors can cancel a dividend on a preferred without triggering a credit event. You can't do that on debt. And that's what makes preferred for companies, slightly better than debt, is if there is a chance where they have to conserve cash, they can do that on the preferreds that they cannot do on the debt. They can cancel the dividend. On liquidation, preferreds have a higher priority claim on net assets than common. That's where you get the term preference. It has a preference. There's a preference for dividends over common and a preference in liquidation. They can be perpetual preferreds, which means they have no maturity date. They last forever and ever and ever. They can be convertible preferreds, and we're going to see that this is typically used in private equity deals and venture capital deals, but you can buy convertible preferreds. A company can issue convertible preferreds in the market. The nice thing about issuing a convertible preferred in the market is you can issue it with a lower dividend yield. Why? Because there's value for the holder of the convertible preferred. They have an embedded option, and that option has value for the holder. They can be callable. They can be puttable. Most preferreds typically are callable, and they can be puttable. They price like debt. That's why I say it prices like debt, and it pays like equity. So if you're in a jurisdiction where if you're earning interest income, and interest income is taxed at your regular tax rate of income, if you got to claim interest as straight income, or you can get dividends, and if you're in one of those jurisdictions where if you have dividends of your home country, you have favorable tax treatment. You have a dividend tax credit, perhaps, that you can get off the dividend. You would much rather get $1 in dividend than $1 in interest, which is why the fixed preferreds on AA rated companies are a safer bet and a much higher yielding asset for a retiree than any debt instrument is. And it's an underrated security, the preferred shares, especially for income oriented investors later in life. Don't put them in debt. Get them in some nice preferreds, because if there's a tax advantage associated with that dividend, it's far better for them. Some other features of preferred shares, they might have a clause that says they are cumulative preferred. That means that, and I said earlier, even though preferreds have that stated dividend yield and a preference for dividends, it's still discretionary. If a company cancels the dividend, a cumulative preferred means that all unpaid dividends accrue over time and must be paid in full before any common dividends can be paid. So I can also get my yield down on my preferred shares if I'm a company issuing preferred shares by saying, you know what, I'm going to make them cumulative. Now there's less risk involved. I can get away with a lower yield on it. Or they can be non-cumulative, which means if I cancel the dividend, that's it. I just cancel the dividend. They do not accrue. They are forfeited permanently, and they will have to offer a higher yield. I, as the issuing company, will have to pay to have it non-cumulative. For me to reserve that right to say, you know what, I don't want to pay you anymore, I'm going to have to pay a higher amount while they're continuing. They can be participating, and participating is usually seen in private equity deals, especially venture capital, where you have things like 2x or 3x participating. And you got to be very careful with that. And since we're not really talking about alternative investments here, I'm not going to get too much into how dangerous that participating clause can be for the entrepreneur. But here's what participating means. It can mean one of two things. Number one, the preferred shares get to participate in any increase in dividends if the company's profit exceeds some level. So there might be some benchmark level or some hurdle rate that if the company's profit exceeds that, then the preferreds would participate in any upside. Or if the company issues special dividends. So you take a company that every now and then might issue a $5 or $6 per share special dividend. There might be a clause where the preferred say, hey, that's a special dividend now. We get to participate in that as well at some ratio. So there's number one. That's the first way they can participate. The second way is in the proceeds from a liquidity event. And this is very common in venture capital. For instance, 2x participating. So let's say that I fund your business. And let me see if I can get a nice color here. I fund your business with $15 million. I'm a venture capital. And I do it by issuing myself 2x participating preferreds. and we sell your company for $35 million 2 years later. Woohoo! You think, wow, look at that, you made 20. You did not. It's 2x participating. So if the preferred shares were 25 par value, I get $50 distribution first. So because I put in 15, I don't just get my 15 back. I get 2 times participating, I get 30 back. So there's only 5, but my ownership might represent 40% of the company. I get another 40% of that. You as the entrepreneur, you get screwed over if you don't understand this participating clause from a liquidity event. It's not just in dividends. It could be that it's in the liquidity event as well. Well, if we have participating preferred, then there's obviously non-participating preferred. So your stated preferred dividend is all that you get, plus whatever your par value is, if it's callable or if it's redeemed, whatever the case is. But that's all you get is just the basic par. Even in a liquidity event, if there's more money than your par value, that's still all you get with non-participating. They can be convertible to common. So you participate in equity participation while getting a higher yield. You'll get a higher yield than you would if you own the common shares to begin with, but you would not get a higher yield on convertible versus straight preferreds. Straight preferreds that are non-convertible will offer a higher yield than convertibles, and convertibles will offer a higher yield than common. So you'll get the equity upside because it's convertible, but while you're waiting, you'll get the higher dividend yield. This is very common in private equity, is to issue convertible preferred. Now, why would private venture capital invest in your business? They'll invest in your business by issuing convertible preferred. And you have to think about that for a minute, is why would they issue the preferreds? Typically, in a venture capital arrangement, the preferreds don't pay a yield. They're just convertible. They don't pay a yield. So what do you need a preferred for? Well, for 2 reasons. Number one, they're still first in a liquidity event. But the big reason why you would issue preferred shares in a privately held company is so that you do not reprice the common. If you reprice the common, you might trigger a tax event for the entrepreneurs. You might trigger a tax event where suddenly they have to claim a capital gain on that tax event because they owned 100% of the company, they sold 1% of the company, they're deemed to have achieved a capital gain. But if you don't, if you issue shares in terms of the of preferred shares instead of more common, well, you haven't sold any common shares. You've just raised a different type of equity. You've raised preferred. You don't reprice the common. So when VCs issue convertible preferred, it's because they want common, but they issue the preferred first so as not to reprice the common and trigger a tax event. Wherever there's convertible preferred shares, I guarantee you there's going to be a forced conversion clause. And this is what the forced conversion does. If the common share price is greater than the conversion price for, let's say, a period of 5 days in a row or whatever it is, whatever the clause calls for, if it is worth it for the investor to convert, the company may force conversion by calling the shares back at a lower price. So the company may say, in the event that it is worth it for you to convert your preferred shares and you do not, I'll give you 5 days to convert. If you don't, I get to call it back at a much worse price. In other words, it's in your interest to convert or I'll call it back and you'll lose money. That's called a forced conversion. Now you may wonder, why would a company force you to convert? Well, they don't want to pay that dividend. They don't want to keep paying that dividend. Now, if I didn't have to convert, I would say, why would I ever take a lower preference on dividends? Why would I ever take a lower preference on any liquidity event when my preferred shares will trade off the common stock because they're convertible, so I have the same value that the common has, and I get the bigger dividend? When you don't have a forced conversion clause and your convertible preferreds are not converting, you have a situation called overhanging convertibles. Is you can't get them to convert and they're a cash drain. So that's why companies that issue convertible preferreds will have a forced conversion clause forcing you to convert. That doesn't work for private equity, by the way, because how could you ever tell whether the common price is greater than the conversion price? It's all subjective. Well, not really subjective, but it's not market determined. So any publicly traded convertible preferred share out there, if you read the prospectus, you will find, I guarantee you will find a forced conversion clause. We're on LOSC now, and the key word here is to distinguish. Distinguish between public and private equity securities. Well, I think we can make quick work of public securities. That's everything traded on a public exchange. The process is a company does an IPO, an initial public offering, that key with the words right in there, and the shares then trade on secondary markets, which is any exchange that you see. Those are public securities or public equity. Private equity, basically, there is no secondary market. There is no public market whatsoever. It's done not through an IPO, but it finds its way into life through a private placement. Typically institutional investors like private equity or venture capital, that's where the serious money is. You can have that gap funding right at the very beginning of a firm's life where angel investors play, but we're not even going to touch that. Typically, institutional investors are accredited investors. There's no secondary market. They're not listed on public exchanges. Their prices are not market determined. And because they're not listed on public exchanges, because they have no market determined price, you can just make the conclusion that they're illiquid because you got to find another buyer for them. The issuer is not required by regulation, by the way, not required to publish financial statements. So if I'm a private company that's venture capital financed, I don't got to publish anything. My VC might want to see my statements, my quarterly statements and my annual statements, but I don't have to actually post them anywhere. No one has to ever see anything unless, and this is only certain jurisdictions that will have this rule, unless the number of shareholders in your private company is greater than 50. The moment I hit 50 shareholders, I am classified as a public company. Even though I'm private, I'll be called a public company, and I'll still have to conform to all the regulations that would apply to a public company. So I'd want to keep the number of shareholders I have at 49. And as soon as I go over, well, then now I'm in trouble. But if the number of shareholders of a private company get too large, the regulators look at that and say, that looks public to me, because the number of shareholders, you got to report as if you are a public company at that point. So let's look at the types of private investments. And this is really more alternative investment. And you'll see more of this in the alternative investment reading, and especially level 2 when you get more into alternative investments. Number 1, venture capital. And they typically provide seed, anywhere from seed financing all the way to growth financing. The VC firm is set up as a limited partnership. Usually with a 10-year life. It lives for 10 years. It'll spend the first 3 to 5 years making investments. That's the investment phase. After about year 5, they move into the harvest phase, year 5 through 10, where they sell companies through another larger company wants to acquire a company in their portfolio. Hopefully they can IPO, but that's rare. Typically it's 1 in 10. Or liquidate. Of 10 investments that a VC makes, typically they'll have 3 to 4 that are either IPO or acquired, and they'll have 6 to 7 that are just the walking dead, that they end up liquidating or making some other arrangements for, but that's typically how the payoff goes. So whenever they invest, they are really looking for a 10x. They invest $2 million, they want to see that they can get $20 million out. There's a whole course that you can arrange just around VC investing, term sheets, how to structure a term sheet, how to read one, how to negotiate one, the structure of the VC firm, etc. But that's as far as we go. Just understand that this is nothing. This is just a brief intro to the term venture capital, but it's a deep, deep subject on its own. Number two, a leveraged buyout or a management buyout. This is the same thing, by the way. An LBO, a leveraged buyout, is a group of investors using a lot of debt to buy out a firm, probably a public firm, and take it private, strip it out, sell off some of the good assets, restructure it, and then reintroduce it into the market. If the group of investors are made up of management, it's just called an MBO, but it's really the same thing. It's the use of debt to purchase all outstanding shares of a publicly traded company, and it's usually restructured and then reissued. The most famous one in the LBO case is RJR Nabisco. RJR Nabisco. And if you want to learn more about this, there is the movie is on YouTube. It's called Barbarians at the Gate. Let me write that down for you. I always have trouble with these barbarians. I'm going to say Barbarians at the Gate. And it's worth watching because it is about the very highly leveraged LBO of RJR Nabisco and the fight that went on between the management group and an outside group of investors to buy RJR Nabisco. You might want to watch Barbarians at the Gate. I think it was done in the 80s, so it's like an 80s style movie as far as being cinematographically great. Not so much, but it tells a great story. I recommend it. A third type of private investment is what's called a private investment in public equity, PIPE. In other words, it's a publicly traded company, but a private investment is being made in the equity of that publicly traded company. That sounds odd, right? Typically called restricted stock. The stock is restricted. It is non-tradable, mostly done through preferreds. Usually at a discount to whatever the market price is. For instance, in the global crisis of 2008, Warren Buffett did two of these deals. One with GM, and one with Goldman Sachs, where he put $5 billion into each of these. $5 billion in preferreds. They were perpetual preferreds, and what do you think he charged as interest? Because it was a tough time, you're going to pay 10%, he says. 10% a year on perpetual preferreds. Plus, he extracted out of both GM and Goldman Sachs 5-year calls, warrants. I wouldn't call them calls, they're warrants. Warrants are calls. But 5-year warrants to buy more stock at a given strike price for 5 years. So that's a really sweet deal. But that was not issued through the public markets. That was a private investment that he made in publicly traded companies. There's your public equity right there. And this was the private investment made through the use of perpetual preferreds. The advantage of private equity. Management is focused more on long-term value creation. You don't have to meet the street every 3 months. And that's what Berkshire Hathaway is about and what Warren Buffett does. He takes very good companies, takes them private, and takes them out of the public eye so that they can start focusing on 3, 4, 5, 6-year long-term value creation plans as opposed to meeting the street every 3 months to meet earnings. They are inefficient markets. You might think, how is that an advantage? They are inefficient markets. Well, go back to the last reading. We talked about market efficiency. Where we find efficiency, we find the ability to earn higher risk-adjusted returns. In inefficient markets, we can earn higher risk-adjusted returns. Lower company costs due to a lack of filing requirements, listing fees, regulatory costs, so that the companies, when Warren Buffett takes a company private, it can shed a lot of the costs associated just with being a public company. So suddenly that cash flow is there for the rest of the investors because now it's private. It doesn't have to be spent that way. Moving on to LOSD, our keyword here is to describe. Describe methods for investing in non-domestic equity securities. And let's get a setting for this. Companies are able to issue shares in international markets. They don't just have to issue in their domestic market. They can issue internationally. They get a wider shareholder base and a lower cost of capital, perhaps, because maybe another region might be more willing to accept the equity issue than another region, price it at a lower cost. They might achieve a lower cost of capital. Investors, on the other hand, gain access to foreign companies so that they can diversify their risk away from domestic-only exposure or to home country exposure only, because most investors show a home country bias. So that a Canadian investor will be all in Canadian equities. Well, and here's the thing. We have laws, tax laws set up to encourage us not to diversify away from Canadian equities. If we're getting dividends, it doesn't, or capital gains, it doesn't help us if it's not Canadian. We have a much better tax system if they are Canadian. So sometimes a tax policy might defeat this sort of thing where a foreign company issues shares in our market. It'd be like, what's the point? But if we don't want to be subject to home country bias, if you're running a larger portfolio of equities, 100 million, 200 million, a billion, you want to avoid that home country bias. You want to shop the globe. It diversifies risk away from any one country. There are restrictions, even though it has a benefit for the companies and has a benefit for the investors. Countries still put restrictions on who can own what. And Canada does a lot of this as well. Reasons limit the amount of control foreign investors have over domestic companies. And Canada has some rules saying that some industries, some companies, simply cannot be bought by outside investors. For example, we have one company in Saskatchewan here called Potash. Its ticker is POT. And roughly about, I'm going to go back 6 years, 5-6 years ago, an Australian company wanted to buy potash at a nice premium. And the Canadian government said, no way. Can't do it because it is a strategic asset to Canada. You can't have it. So there are restrictions to that. Another reason a restriction would exist is to give domestic investors the opportunity to own the shares of the foreign companies conducting business in the domestic market. So if a foreign company wants to come into a specific country, there might be a law that says 51% ownership must be domestic. So let's say company ABC wants to invest in a different country. ABC has to be willing to give 49% of control, give up 51% of control to the domestic investors in that country. Some companies don't want to do that. And some countries do it to reduce the volatility of capital inflows and outflows. If there's a lot of money coming into a country, it tends to push up the currency because you got to buy the local currency to buy the shares. When that market is over and investors want out, they sell the shares, and then you got to sell the local currency to get back into your own currency. It tends to drive the currency down. So you have a currency that shows a whole bunch of volatility because of these capital inflows and outflows, and they want to avoid that. So despite those restrictions that we've looked at for countries that try to limit foreign investment in their domestic equity markets, research has shown that if you reduce those restrictions, it tends to lead to improved equity market performance. So it benefits the domestic market in the sense that domestic shareholders will benefit from that inflow of funds. An increased number of companies have issued shares in markets outside their home country, called dual listing. And the benefits of doing that is to improve awareness about the company's products or services, because now they're listed in different countries. They become available to different investors that might never have seen them before. And suddenly we say, well, what do they do? What do they sell? Aha. Not only that, the financial press tends to report on them more often. Enhances the liquidity of the shares. It increases corporate transparency, because if you're listed in 3 or 4 countries, you need to meet a greater number of filing requirements. And if you're in 5 different countries, you're going to at least have to file at the most stringent level. So let's say you're in a country that's really stringent on the filing requirements, and you're in a bunch of other countries that aren't. You still got to meet this requirement. So that means all of these markets still have access to all of the filings you have to meet for the most stringent country that you're listed in. So how do we achieve this? Well, direct investing. We can buy or sell directly in foreign markets. The purchase price, the sale price, the gains, the losses, and the dividends are all in the foreign currency, however. So if you're a British investor investing in the U.S. market, you're going to have to sell your pounds to get dollars to purchase the stock. When you sell, you're going to have to reconvert. All your gains or losses will be in U.S. dollars. Your dividends will be received in U.S. dollars, and because you're in Great Britain, you're not going to get the full dividend. There's going to be a withholding tax at the country level. So the U.S. will just reach in and grab 15% of that dividend right away, and then the rest comes to you. So you open yourself up to exchange rate risk. You have to go in and out of the market. There's exchange rate risk right there. Secondly, you must be familiar with the trading, clearing, and settlement regulations of the foreign market. That's typically not a big deal, especially in developed markets. They're pretty much all the same. It's typically not a big deal. May lead to less transparency and more volatility, especially if you're investing in less developed markets. But if you're in a less developed market, investing in a more developed market, you get the opposite. You'll get more transparency and less volatility. Another way to gain access to foreign equities is through depository receipts. And these are receipts, not shares, they're receipts. They trade like an ordinary share on a local exchange, and they represent an economic interest in a foreign company. So let's see how these things are actually created. So here's our domestic market. Here's our foreign company over here. Our foreign company will deposit some shares with a domestic bank, and the domestic bank will act as the transfer agent and the custodian of the shares. The domestic bank does not issue the shares on the exchange, but instead issues receipts on the exchange, and the receipts, the collective amount of the receipts, represent the ownership interest in all the shares. Now, the receipts they issue may not be 1 for 1, so it might take 5 receipts to equal 1 share. It may be 1 for 1, but it may not. It does not necessarily have to be 1 for 1. So you might, when you're looking at a depository receipt, you're going to want to do a little bit of reading to see what the ratio to receipts to shares are. So the buyer, when it buys on the domestic exchange, when it buys these receipts, will buy and sell in the domestic currency and receive their dividends in the domestic currency. The seller, same thing, will buy and sell in the domestic currency, and all dividends are in the domestic currency. So that is what a depository receipt is. The foreign company deposits shares with a domestic bank. The bank is called the depository. The depository issues receipts. The receipts are traded on the exchange, and now you have domestic currency in and out. Now you may think, well, that gets rid of foreign currency risk, doesn't it? No, it doesn't. It doesn't get rid of foreign currency risk. It just gets rid of the foreign currency. The foreign company, the shares are still priced in the foreign company's currency, which means that even if the shares stay flat, but the exchange rate changes, the receipts will change in price, but they'll change in the domestic price. So when you're going in and out, you're going in and out in your domestic currency. You don't have to worry about exchanging the currency, but you still have exchange rate risk. Let's be clear about that. A little bit more vocabulary here. Depository receipts can be sponsored or unsponsored. And sponsored means that the foreign company has a direct involvement in the issuance of the receipts. The investors in the depository receipts have the same rights as the direct owners. The investors. That's an important distinction here. The investors have the same rights as the direct owners. There is a level 1 ADR, a depository receipt. This is American depository receipt. Level 1 ADR means they trade OTC only. So they don't hit an exchange, they trade OTC. Level 2 and 3 means they trade on an exchange, so they must register with the SEC and follow regulatory guidelines. The difference between a level 2 and a level 3 is level 2 is just the issuance of the receipts. Level 3 is to actually raise money. So the shares that are deposited with the depository are brand new shares. So when the receipts are issued on the market, it actually raises money for the company in the foreign market. And then there's Rule 144A. This is qualified institutional buyers only, private placements. Unsponsored means the foreign company has no direct involvement in the issuance of the receipts. And here's the big difference, coming up to it now. The depository has the rights of ownership, not the investor. When they're sponsored, the investor has the rights of ownership. When they're unsponsored, the depository has the rights of ownership, not the investor. Still with depository receipts, we're going to make a distinction between two types here, a GDR and an ADR. I've already sort of alluded to the ADR earlier, but a GDR is a global depository receipt. The ADR is an American depository receipt. For the GDR, it is issued by a depository, which some bank issued by a depository, typically in US dollars, issued by a depository bank outside of both the issuer's home country and the US. So in other words, they're depository receipts that trade on exchanges that are not in the home country of the company or in the US, except for a private placement. You can still have a global depository receipt issued in the US by a private placement and still have it referred to as a GDR. An ADR, on the other hand, is denominated in US dollars and trade like common shares in the US. In other words, they are issued in the US, hence the term American. Global registered shares. This is a third type of way to gain access to foreign companies. Ordinary shares that are quoted and traded in different currencies on different stock markets. For example, the Canadian banks. We got 6 big Canadian banks. They all trade on the TSX, but they all trade on the New York Stock Exchange. Here's the thing. Let's take 2 of them, Bank of Montreal and TD. The BOM and TD trade on the TSX in Canadian dollars. So if you look at the TSX and get a price on these, you'll find a Canadian price. You'll also find them on the NYSE. And you look at them and you go, but it's a cheaper price on the New York Stock Exchange. Yes, because it's in US dollars. And since it's in US dollars, it's going to have a different price by the amount of the exchange rate. That is not all. If you look at the dividend yield on the Bank of Montreal and TD, they will be higher. The dividend yield will be higher in Canadian than it is in US because of the withholding. Because of the withholding tax, you will have a higher yield. If you're a Canadian investor, there's no point in holding your Canadian banks in US dollars unless you're making a specific bet on the US dollar itself. You'd hold it in Canadian dollars and then do something else in the US. But when you look at the difference between the two, they are listed on different exchanges in the currency of whatever exchange they're listed on. That's called a global registered share. And finally, number 4, a basket of listed depository receipts, a BLDR. And this is nothing more than an ETF. It's an ETF made up of a whole bunch of depository receipts. We are now on our next learning objective, which is LOSE. And LOSE, keyword here is to compare. Compare the risk and return characteristics of different types of equity securities. The risk and return characteristics. So, let's look at return before we can look at risk. Let's do that first, and then we'll get a better understanding of where risk is, because risk is always in our certainty about our return. So where does return come from? There are two main sources of return in any, and I'm going to be very clear, I'm departing from the book now. I'm departing from the book in terminology only, but not in content, in terminology. I want to be clear. There are two main sources of return in any one period. The book doesn't make that distinction, I am. In any one period, we have two sources of return, the capital gain or the dividend. So if we look at RT is total return equals the price today minus the price at the beginning of the period. That's the difference in price. That is our capital gain. That's the change in price. Plus DT, total dividends. That's the dividend. Divided by the starting price to get our return, right? So there's our capital change. There's our dividend. And there's our starting price, our original investment to get our total return. In any one period, we can get capital gains or dividends. For depository receipts and direct foreign investment, we may also have currency gains. And just to make sure we're not always one-sided, we can also have currency losses. Here you can have capital gains and capital losses. It's hard to have negative dividends, though. And our fourth type of return for equities is if we're holding over multiple periods. That's why I say this is the return for one period. Over multiple periods, it's 1, 2, possibly 3, but also 4, dividend reinvestment. We get a compounding effect, and this is absolutely huge. You've got to reinvest those dividends. Now, the book doesn't make a distinction on this. It talks about dividend reinvestment in terms of buying more shares of the same company. You don't have to do that. In fact, that's a riskier way to get a compounding effect because now you're concentrating your holding in one equity. If you're going to reinvest that dividend, it does not have to be the same company. You can buy shares of another company that also pay a dividend. And if the yield is the same or higher, you do even better. Well, I shouldn't say even better, but you're getting a diversification at the same yield. If you can get a higher yield, you're doing even better. So the key message here for reinvestment is this word here, reinvestment in any other equity that also pays a dividend. It doesn't have to be the same one. The sentence in the book that talks about dividend reinvestments, it says you keep buying more of the same stock. Well, if you want to continue on holding the same percentage of that stock in your portfolio as other stocks, then you're going to reinvest all your dividends back into the very thing that paid you that dividend. Then okay. But if you want to diversify, then it doesn't have to be the same company. By the way, before I leave here, again, the book doesn't really go into this. If you are going to continually reinvest back into the same company, many companies offer a DRIP, D-R-I-P, a dividend reinvestment plan. You're going to want to sign up for the DRIP. And here's why. Is because there are no transaction fees. You just get paid in more shares. There are no transaction fees. Number two, you get immediate investment, which means that as soon as you get paid your dividend, you'll get shares. Those shares start earning a dividend as well. So you'll get immediate reinvestment. But the big thing is that typically you'll get a 3 to 5% market discount. You get a 3 to 5% market discount from the market price at the time of the payment date on the stock. So if you're going to reinvest back into the same thing, just sign up for the DRIP. If you're going to diversify your reinvestment, then you can pick any company. The point is reinvest. That's the big point. All right. So there's our sources of return. Capital gains, dividends, our compounding effect with reinvestment, and potentially currency gains. So risk, therefore, refers to the uncertainty of the above future returns and cash flows. It refers to the uncertainty of capital gains, the uncertainty of the dividends, the uncertainty of our reinvestment, because if we're reinvesting back in the same thing, well, it has capital gain uncertainty and dividend uncertainty. So we're reinvesting back into more uncertainty. That's why I say it doesn't have to be the same company. You can actually reduce some of that uncertainty with diversification. So let's look at this idea of risk. We get where our return comes from. Now let's look at risk. We mentioned two types of equities before, preferreds and commons. We can make a statement here. Preferreds are less risky than common. The preferred dividend is known and fixed generally. You might have rate reset preferreds where it is not known and fixed. So the preferred dividend is known and fixed. That is the DT component, the dividend component of the numerator before our dividend. And the dividend accounts for a large portion of the preferred share's total return because it pretty much tends to hug its par value over its life, $25 or whatever it is. So because the dividend is known and fixed, and we're not worried about any capital appreciation, or it's not a significant thing, there is less uncertainty about future cash flows. Less uncertainty means less risk. That's why we can make that statement. Preferreds receive a dividend and distributions before common, and the distribution's only up to par, but they do receive it before common. But they do rank behind all debt, but that still makes it less risky than the common. And cumulative preferreds are less risky than non-cumulative preferreds because even if the dividend is discretionarily canceled, cumulative means company's got to make good on it at some point. Common shares, a large part of the total return on common shares is made up instead of the price appreciation component of the numerator. PT minus PT minus 1. PT minus PT minus 1. And that is the price appreciation or the price change component of the numerator. Puttable shares are less risky than callable or non-callable common, and callable is more risky than non-callable. Why is callable more risky? Well, because you can only go up to a certain price before you can't go any higher. Now, I've mentioned before that I've never bumped up against puttable and callable shares at all. I've never bumped up against them. But here's what you can do once we get to derivatives. You can create your own puttable shares and you can create your own callable shares. You don't need a company to do it for you. You can create it yourself. And since creating callable shares generates revenue, you can actually generate revenue by taking your basic common shares and turning them into callable, which actually tends to lower your risk in case the price declines, but increases your risk in case the price goes up. So when we say that callable is more risky than non-callable, they're both the same risk on the downside. Finally, public equity is less risky than private equity. Why? Because you have liquidity, you can get out. Private equity, illiquidity costs money. You have an illiquidity premium built into the required rate of return. That makes it more risky, which means you got to get it at a lower price. We are on the next two learning objectives now, LOSF and LOSG. Keywords here are to explain and distinguish, and F is explain the role of equity securities in the financing of a company's assets. I think we can make quick work of that. And G is to distinguish between market value and book value of equity securities, and we'll take a bit of time there. But explain the role of equity in financing a company's assets. You'll recall the basic accounting equation. Assets equal liabilities plus equity. So we can finance our assets either with debt or through equity. And equity is a share issue, whether it be preferred or common share issue. So companies issue equity to raise capital, and that capital is used to finance assets. It can be used for many reasons and many uses. Maybe you're investing in R&D, maybe you're investing in growth, maybe you're using your shares to buy out another company, maybe you're raising cash to build or to expand the number of stores or locations you have, whatever the case is. It is just another way to access capital to expand your operations or to finance your operations. Ultimately, the ultimate goal of management, we say, is to maximize return. It's to maximize return. But when we maximize return, the ultimate goal of management is to increase the book value of the company and maximize the market value of its equity. Now, let's look at the two. Our book value is basically just assets minus liability. At the heart of it, that's all it is. It's just a net claim on assets. That's what equity is. Because if you look at assets equal liabilities plus equity, equity must be assets minus liability. There's the book value of your equity. The biggest component of your equity that management has direct control over is retained earnings, which means be as profitable as you can. So we say that the goal of management is to maximize the profit, maximize profitability it'll trickle down into retained earnings, which will increase the book value of equity. Typically, there is a direct correlation between the increasing in the book value of equity and a reflection in market value. That does not necessarily have to be so. The market value is take the number of shares you have and multiply it by whatever price you're trading at in the market at that time. And the price is determined by investors. It's market driven. It's determined by investors' expectations about the amount, timing, and uncertainty of future cash flows. So, you may have a situation where you are doing very well in generating revenue, in generating net income, but you are not doing well in reducing the perceived risk of your business. The increase in book value may not trickle down into an increase in market value, especially if the market sees that your increase in earnings is actually leading to your being more risky and not less risky. Perhaps you have moved from 10 different customers to a concentration in one big customer now. Well, that's very risky cash flow. So even though you might increase your book value, the market may say, look, your risk, this is what you have to manage, Mr. Management, is you have to manage the uncertainty about the amount, timing, and uncertainty of your future cash flows. For book value, you're just managing your net income. So now that we know the distinction between a book value and a market value of equity, let's look at how we can use the book value to take some measurements here. And the big one that we can do is return on equity, and we're going to need that shortly. This is called our accounting return on equity. Why? Because net income is an accounting-derived measure, our accounting return on equity, and we're using our book value of equity at this point. So it's net income at time t divided by our average book value of equity at time t. Average is just book value of equity at t plus book value of equity at t minus 1 over 2. And with this will give us our return on equity. And let's note something right now, that net income in the numerator here is total net income available to common shareholders only. In other words, it's net income minus the preferred dividend. So our numerator is not the income statement net income. It is the net income after we've taken off preferred shares. If we got no preferred shares on the books, if equity has no preferreds in it, then the net income is the line item on the income statement. But let's be aware of that. We really should be writing it as net income minus preferred dividends, just so that it's explicitly clear, just so that we do know that. So there we go. Now, our return on equity can increase if our net income rises faster than our book value of equity, or if our net income falls slower than our book value of equity. Well, that's not a good thing. The first one's pretty good, but the second one is not a very good thing. So think about a situation where your net income is falling slower than the book value of equity. Your return on equity will increase, which is your book value of equity, the return on the book value. But you'll look at your market value of equity and you'll say, wait a minute, that's going the wrong way. It's going the other way. Yes. So you could have that paradoxical effect where our return on equity keeps increasing year after year, but our market value of equity keeps dropping, because you can get that number higher through this unfortunate situation. We can look at a price-to-book ratio, which will give us some indication of the direction of the book value of equity along with the market value of equity. And it's the market value of equity per share divided by the book value of equity per share, which I think is rather stupid, because if you actually multiply that out, the per shares cancel, and you'll just get the market value of equity divided by the book value of equity. Why divided by the share price and then take the ratio when it's the same thing, right? Anyways, so we have the market value of equity, which means we take our share count at the end of the year, which we'll get off the balance sheet, multiply it by the price at the date of the balance sheet, if you want to be really honest with the book value of equity, because the book value of equity is as of the balance sheet date. So if you're going to do this ratio, you want to take the market value of equity, you want to use the price in the marketplace as of the balance sheet date to see the exact true relationship between these two, because book value of equity is only that for that date, right? So just take the number of shares outstanding multiplied by the price and divided by the line item, total shareholder equity, on your balance sheet, and you'll get a ratio. The higher the ratio, A higher ratio indicates that the market is pricing in higher future growth opportunities. They're pricing in higher future growth opportunities. They perceive your company as less risky than one that might have a lower ratio. And we are now on the last learning objective of this reading, LOSH. Keyword here is to compare. Compare a company's cost of equity, its accounting return on equity, and investors' required rates of return. This is really a look ahead to corporate finance. We're going to see more of this in corporate finance, so we'll do it briefly here because you're going to see more of it there. Return on equity, that is the rate of return earned by a company on its equity capital. It uses accounting net income, which is subject to estimates and methods. We've already been through this. If you've been through the FRA, the Financial Reporting and Analysis, we've already seen this a lot. We know that ROE can be managed. One thing we can do to manage ROE is we can issue debt to buy back shares. Well, when we buy back shares, what are we doing? We're changing our capital structure. We're making it more liability heavy and less equity heavy. We're decreasing equity. So the book value of equity drops. Well, that's the denominator of our ratio. So if we have net income over average book value of equity, and we can decrease the book value of equity by simply using debt to buy back shares, we can improve our ROE. Simple as that, right? The intrinsic value of equity is the present value of all expected future cash flows discounted at the required rate of return. So we needed to compare three things in this. The company's cost of equity, its accounting return on equity. We've already covered the accounting return on equity, and the investor's required rate of return. Well, that's where the required rate of return comes in, is when we discount the expected future cash flows. Now, expected future cash flows is an estimate. Same with the required rate of return. That's an estimate, because not everybody has the same required rate of return. 10 investors can look at a company and all see different levels of risk and all have different required rates of return. How do you know what's what? It's easier with a bond in the sense that you can look at a government bond that's rated AA, that has certain characteristics, and take 10 investors. They'll all pretty much come to the same required rate of return, whatever the market interest rate is on that class of security. Not so with equity. You take 10 investors around the world and ask them to find the intrinsic value of an equity. I would strongly doubt that any two of them would come up with the same price. I would strongly doubt that, because they'll all have different views of the expected future cash flows, and they'll all have subjective required rates of return based on what they think is appropriate. So that is where the required rate of return comes in. Now, the cost of equity, that really is a corporate finance thing. We will see this way in detail when we get to corporate finance, so we won't spend too much time on it. The cost of equity is the discount rate needed to equate the expected future cash flows with the offering price of the equity. That is the cost of equity. We'll see that a lot more in corporate finance. We'll actually calculate the cost of equity at that time. So let's not go into something that we're only going to repeat later on. Let's just keep that in mind, that that's what that is.